Welcome to The Explainer. Today, we're going to crack open the playbook of a professional stock analyst. We're going to walk through the exact steps they take using a real-world report to see how they try to spot a potential winner.
From the outside, it can seem like some kind of secret art, full of jargon and weird formulas. But the truth is, there's a really clear, logical process behind it all. It's a playbook for making smart, informed decisions.
So, to get our hands dirty, we're going to dissect an actual financial report on a company called Shilchar Technologies. This is going to be our blueprint for seeing how analysts connect all the dots, from the huge economic picture right down to a single stock. Let's jump in. All right, so where does an analyst even start? Well, rule number one is you always start with the big picture. Before we even whisper the company's name, we have to understand the world it lives in. For any analyst, context is everything. And boy, this industry has some serious momentum. We're talking about massive government spending on infrastructure, a huge push into renewable energy, and this urgent need to upgrade a power grid that's, getting pretty old. And look, these aren't just little blips on the radar. These are powerful trends that will drive demand for years to come. And get a load of this number. To put it in perspective, the government is pumping over 10 trillion rupees into infrastructure every single year. Now, if you're a company that makes the essential gear for that power grid, that's not just a tailwind, it's a tidal wave of opportunity. Okay, so we've established we have a booming industry. Now, let's zoom in from that 30,000-foot view to the company itself and see exactly where Shilchar fits into this whole puzzle. So what does Shilchar actually do? Well, simply put, they build transformers. Think of them like the traffic cops of the electrical grid. They manage the voltage, making sure all that power gets from the giant power plants safely and efficiently to our homes and businesses. They're a totally essential link in the chain. So what's so special about them? Well, the analysis really drills down on its core strengths. They have deep technical know-how, they've got long-term contracts locked in with the big utility companies, and they have top-of-the-line factories. This shows it's not just a company riding an industry wave, it's actually built to navigate it well. Okay, so this story is great, right? Right industry, solid business, but what about the money? Are the books solid? Now we get into the really juicy stuff, the financials. Whoa, okay, the first thing that just jumps right out at you is this number, 28.4%. That's their average revenue growth per year for the last 5 years. That isn't a one-time fluke, that is proof of sustained, powerful growth. Next up, a number that's a real sign of quality, return on equity. At over 18%, this tells you how good the company is at making a profit from its shareholders' money. A high ROE like this, that's a huge green flag for an analyst. And it's really impressive? They've managed all that growth without drowning in debt. A debt-to-equity ratio under 1 at 0.72 is considered very healthy. It tells you that the management is being careful, and that's exactly what you want to see. But look, no company is perfect, and a real analysis never just shows you the good stuff. It's got to be balanced. So on one side, you have that fantastic growth and strong profits. But on the other, the report flags things like a big need for cash to run the day-to-day business and a heavy reliance on government contracts. It's a clear-eyed look at both the pros and the cons. So we've seen where they are financially. The big question now is, where are they going? What's the plan to keep that momentum going? And the report lays out their game plan pretty clearly. They're not just sitting still. They're planning to boost their manufacturing capacity, move into more profitable specialty products, expand their reach, and even start looking at export markets. This is their roadmap to really ride those industry waves we talked about.
Okay, we've looked at the industry. We've looked at the company. We've looked at the numbers and the future plans. It all boils down to this one moment. What's the final call? What's the verdict?
So how do they get to that verdict? It's not a gut feeling. They use a disciplined scoring system, kind of like a report card. And check this out. Notice what gets the most weight. Financial health and growth prospects. Exactly the things we've been focusing on. It's all very methodical. Now for a huge piece of the puzzle. Valuation. In simple terms, is the stock on sale or is it overpriced? And when you look at key metrics like the PE ratio, you can see Shilchar appears to be trading at a pretty nice discount compared to its competitors. For an analyst, that could signal an attractive entry point. So you put all of that together, and here it is, the bottom line. The final recommendation is a buy. The analyst sets a target price of 1,050 rupees, suggesting there could be about 18% upside from where it's trading. But, and you absolutely have to pay attention to this part, a buy rating doesn't mean it's risk-free, far from it. The report is super clear about the things that could go wrong. The business can be cyclical, raw material costs are all over the place, and there's always a risk that their big expansion plans don't go as smoothly as hoped.
And that right there is the heart of investing, isn't it? You have this whole deep dive process that lays out a really compelling story of opportunity, but it also shines a bright light on all the potential risks. Ultimately, weighing that potential against the pitfalls, well, that's where the real art of investing comes in.